The system quietly making you poorer, and how to fight back. Let me ask you something. You work hard. You get paid. And yet, every year, the same paycheck buys a little less. Your groceries cost more. Your rent went up. Your car payment feels heavier. But nobody robbed you. Nobody fired you. Nobody took a single dollar out of your bank account. So where is your money going? Here's the truth nobody teaches you in school: there is a system running in the background of your entire financial life. It decides whether your savings grow or shrink. It decides whether you can afford a home or get priced out. It controls the cost of every loan you'll ever take. It's called the macroeconomy. And until you understand how it works, you are playing the money game without knowing the rules. Welcome back. If this is your first time here, this channel is all about giving you real, practical knowledge about money, no fluff, no jargon, no condescension. Today, we're going deep on macroeconomics. And before you click off, I promise this is not a boring economics lecture. This is the stuff that directly determines whether your financial decisions work or blow up in your face. We're going to break down how the whole economic system actually works, why it affects your wallet in ways you never noticed, and exactly what it means for how you should be managing your money right now. 5 major points. Real examples. Zero textbook language. Let's go. Here's the simplest way to understand the entire economy. Picture a small town. One factory. The factory pays workers. The workers buy groceries. The grocery store owner buys supplies from the factory. Money just keeps going in circles. Now scale that up to 330 million people, thousands of industries, and trillions of dollars, and that's the U.S. economy. Economists call this the circular flow. But the name doesn't matter. What matters is this: everything is connected. The moment one part of that loop breaks down, everything else starts to feel it. Here's a real example. In 2008, housing prices crashed. Banks lost billions. Banks panicked and stopped lending. Businesses couldn't borrow money to run operations. They started laying people off. Now those people stopped spending. Stores lost customers. More businesses shut down. More people got fired. The loop broke, and the whole country went into a recession. Nobody said, "Let's have a recession today." It just cascaded, one domino at a time. Now here's why this matters for you specifically. There are 3 main players in the economic loop. Households, that's you. Businesses. And the government. When all 3 are active and spending, the economy grows. Jobs are available. Salaries go up. Opportunity increases. But when even one of those players pulls back hard, the whole loop starts to stall. Think about COVID in 2020. Households couldn't spend, they were locked at home. Businesses couldn't operate. That left the government as the only player still pumping money into the loop. And they did, trillions of dollars in stimulus checks, loans, and relief programs. Was it perfect? No. Did it prevent a complete economic collapse? Yes. Understanding this loop is critical because it explains why the news you hear about consumer confidence or business investment or government spending isn't just noise. It's a live update on whether the loop is healthy or breaking down, and whether your job, your savings, and your future income are safe. Bottom line, the economy isn't some abstract force. It's a loop. Your spending is part of it. And when the loop slows down, it costs you. Let me be blunt. Inflation is the single most important economic concept for your personal finances, and most people completely misunderstand it. Inflation isn't just, prices are high. Prices being high is called being expensive. Inflation is when prices keep rising over time. It's the speed of the increase, not just the level. Here's an example. If a gallon of milk costs $4 today and $5 next year and $6 the year after, that's inflation. The dollar in your pocket today will only buy 80 cents worth of stuff in a few years. You didn't spend it. You didn't lose it. But its power shrank anyway. Now here's the part that actually stings. Wages almost never keep up with inflation, at least not immediately. So what happens? Your paycheck is the same. But the life it buys gets smaller. That's what economists mean when they talk about real wages falling. You're making the same number on paper, but your actual purchasing power is down. Think about it this way. If inflation runs at 7% and your boss gives you a 3% raise, you actually took a 4% pay cut. Congratulations on your raise, you're poorer. So what causes inflation? There are 4 main causes, and understanding them helps you predict when inflation might hit hard. First, demand inflation. This is when everyone has money and everyone wants to spend it at the same time. Remember 2021. Stimulus checks, pent-up demand from COVID, everyone ordering everything online. Businesses couldn't keep up. So they raised prices. Classic demand inflation. Second, supply inflation. This is when producing things gets more expensive or harder. Think of the supply chain disasters in 2021 and 2022. Ships stuck at ports. Computer chips unavailable. When supply drops, prices go up, even if demand stays the same. Third, monetary inflation. This one is deep but important. When the government or central bank creates a lot of new money without the economy actually producing more goods and services, each dollar becomes slightly less valuable. It's basic supply and demand. More dollars chasing the same amount of stuff means prices go up. Fourth, expectations. This one is psychological and it's wild. If workers expect prices to go up, they demand higher wages. If businesses expect costs to rise, they raise prices now. If consumers expect things to cost more next month, they buy today. All of these behaviors feed inflation, even if the original cause was temporary. Expectations can turn a price spike into a lasting cycle. Here's what you should take away from this for your own finances. Inflation punishes savers who park cash in low-interest accounts. If your savings account earns 0.5% interest but inflation is running at 4%, you're losing 3.5% of your purchasing power every single year. Silently. Automatically. No one sends you a bill. This is why investing, in index funds, real estate, assets that grow, isn't just about getting rich. It's about not getting slowly poor. Most people think their financial life is controlled by how hard they work, how much they earn, or how well they budget. And those things matter. A lot. But there's an institution that can completely override all of your hard work in about 45 minutes, the Federal Reserve. Or just, the Fed is America's central bank. It doesn't take deposits. You can't bank there. You'll never walk past one of their branches. But every single financial decision you make is influenced by what they do. Here's how it works. The Fed controls a key interest rate, called the federal funds rate. That's the rate banks charge each other to borrow money overnight. When the Fed raises that rate, banks' costs go up, so they raise the rates they charge you on mortgages, car loans, credit cards, and business loans. When the Fed cuts that rate, borrowing gets cheaper across the board. Let me make this real. In 2020 and 2021, the Fed cut rates to near zero to help the economy survive COVID. Mortgage rates dropped to historic lows, some people locked in 2.7% or 2.8% on a 30-year mortgage. Houses were flying off the market. Then inflation exploded. The Fed hit the brakes hard, raising rates at the fastest pace in 40 years. By 2023, mortgage rates were around 7 or 8%. The same house that someone financed for $1,500 a month in 2021 now cost over $2,200 a month. Millions of potential buyers got priced out overnight. The Fed didn't change the house. They changed the interest rate. And that changed everything. This isn't just about houses. Higher rates mean credit card debt becomes more crushing, car loans get more expensive, student loan refinancing becomes harder, small businesses struggle to borrow for growth, stocks often drop because future profits get discounted more heavily, lower rates mean the opposite, everything loosens up. Here's the cruel irony. The Fed raises rates specifically to make you spend less, to cool down inflation. It's doing the financial equivalent of stepping on your brake while you're driving uphill. The goal is to slow you down. So you need to pay attention to what the Fed is doing. Not because you can stop it, but because it determines whether now is a good time to lock in a fixed-rate loan, refinance debt, or buy a house, or whether you should wait. The Fed's announcements aren't just news stories. They're signals about your financial strategy. Here's something that surprises most people. The dollar in your pocket has a different value depending on where you are in the world, and that value changes every single day. This is called the exchange rate. And while it might feel irrelevant if you never travel internationally, it actually affects you constantly. Here's how. Most of the stuff sold in American stores comes from somewhere else. Electronics from Asia. Clothes from Southeast Asia. Cars with parts from a dozen countries. When the dollar is strong compared to other currencies, those imports get cheaper for American companies to buy. Which means prices for you can stay lower. When the dollar weakens, those imports cost more. Which flows right into the prices you pay at Walmart, Target, and Amazon. Now, why does a currency get stronger or weaker? Mainly two things: interest rates and economic confidence. When the Fed raises interest rates, international investors look at the U.S. and think, I can earn a better return on my money there. They move money into the U.S., which requires buying U.S. dollars. More demand for dollars, dollar gets stronger. When there's economic chaos or instability, investors flee to safety. And historically, the U.S. dollar is the world's safe haven. In a crisis, everyone buys dollars, even if the U.S. is part of the crisis. Wild, right? On the flip side, countries that have weak currencies face a nightmare. If they borrowed money in U.S. dollars, which many developing countries do, a weakening local currency means those loan payments just became way more expensive. This can spiral into full-blown financial crises. It's happened to Argentina, Turkey, multiple times to countries across Asia and Latin America. Now here's the personal finance angle. When the dollar is strong, this is actually a great time to travel internationally. Your dollar buys more. But it's also a signal that the Fed may be in a tightening cycle, which means borrowing costs are rising at home. And if you're an investor with international exposure, foreign stocks, emerging market ETFs, a strong dollar can actually hurt your returns, because foreign profits convert back into fewer dollars. Trade and currencies aren't just global politics. They're directly connected to how much things cost in your daily life. Nobody likes the word recession. But here's the truth, recessions are a normal part of how economies work. They always have been. They always will be. The economy goes through cycles. Growth. Slowdown. Recession. Recovery. Repeat. Always has, always will. The question is never, will another recession happen? The answer to that is always yes. The question is, will you be ready when it does? Let me explain the cycle quickly. During an expansion, things are good. Jobs are plentiful. Companies are hiring. People are confident. They spend. That spending fuels more production. More production means more jobs. It builds on itself. But at some point, cracks appear. Maybe inflation got too high, so the Fed raised rates. Maybe a financial bubble popped. Maybe an external shock hit, a pandemic, a war, an oil price spike. Spending slows. Businesses get cautious. They stop hiring, maybe start laying off. Consumer confidence drops. People spend less. Companies earn less. More layoffs. The loop you learned about in point 1 starts running in reverse. That's a recession. Technically, 2 consecutive quarters of shrinking economic output. But you feel it as job losses, frozen salaries, and a general sense of dread. Here's what separates people who get crushed in recessions from people who come out stronger. Preparation. First, your emergency fund. This is not optional. Financial experts say 3 to 6 months of expenses in cash. In a recession, jobs disappear fast. Having that cushion means you can survive without panic selling your investments at the worst time. Second, your debt. Variable rate debt is a trap in a rising rate environment. If you have credit cards or adjustable rate loans, pay those down aggressively before a recession hits. Fixed rate debt is much safer because your payments never increase. Third, your investments. Here's something counterintuitive. Recessions are actually when great investors get wealthy. Stocks drop during recessions. That means assets go on sale. If you have cash during a recession, you can buy great companies at discounted prices. The people who bought the S&P 500 during the COVID crash in March 2020 and held it doubled their money in about a year and a half. Recessions punish people who are overextended and underprepared. They reward people who kept their financial house in order. You can't predict exactly when the next one hits. But you can watch for the signals: rising unemployment, the Fed raising rates aggressively, inverted yield curves, falling consumer confidence. These are the warning lights on the economic dashboard. Learn to read them. Let's bring it all together. The macroeconomy is not something that happens to other people. It is happening to you, right now, every day. The rate of inflation eating your savings. The Fed's interest rate decisions changing the cost of your mortgage. The strength of the dollar shifting what you pay for everyday goods. The business cycle determining whether your job is secure or at risk. This is the system your money lives in. And here's the good news: once you understand the system, you stop being a passive victim of it and start making decisions that work with it. When inflation is rising, you move your cash into assets. When the Fed is cutting rates, you consider locking in long-term loans. When the economy is expanding, you invest aggressively. When signs of recession appear, you build your cash cushion and reduce risk. This is not about becoming an economist. It's about knowing enough to stop making expensive mistakes that come from just reacting to life instead of understanding it. The economy is a game. It has rules. Now you know them. If this video helped you see the economy differently, do me one favor: share it with someone who needs to hear it. Most people spend more time researching what show to watch than understanding the system that controls their financial future. That's a costly mistake. Subscribe if you want to keep learning this stuff in plain English. We cover investing, debt, wealth building, and financial strategy every week. And drop a comment below: what's the one thing in today's video that clicked for you? I read every single one.